Hi everyone, my name is Josh, the Florida Mortgage Dude, powered by American Home Mortgage, and today I want to talk about how to mortgage. Now what I mean by how to mortgage is how I pre-qualify buyers to purchase a property. And it's really simple. I look at credit, income, assets, and liabilities, and usually I can get an answer on what we can do for a borrower when they're looking to buy a home. So let's jump right in and start with our first category, which is credit. Now, when we're talking about credit, what do lenders look for? Well, lenders look for things on your credit report like bankruptcies, foreclosures, any negatives like late payments, repossessions on vehicles, anything that could potentially cause an issue with the pre-qualification. Now, we look at credit score, yes, but the other factors that are on the credit report are extremely important because sometimes we have to wait a certain amount of time for those to either fall off or we have waiting periods to meet before we can move forward with a loan. So which credit score do lenders use? So you have 3 credit bureaus that report. You have Experian, TransUnion, and Equifax. Of those 3 scores, the lenders use the middle score for what's called your qualifying credit score. And that qualifying credit score is going to dictate what loan program you can get. So here we have a USDA is a minimum credit score requirement of a 640, conventional is a 620, FHA at 3.5% down is a 580. And if you go 10% down FHA, we can work down to a 500. And then the VA has no minimum credit score requirements. However, most lenders are going to be between that 550 and 580 for a minimum credit score on a VA loan. Now, if you have multiple borrowers on a loan application, the lender is going to use the lower of the 2 qualifying credit scores. All right, so if we move on to liabilities, usually when I talk to borrowers about liabilities, they tell me how much they owe on their vehicles or their credit cards as the total balance due. The lenders don't really care how much you owe, they care what the minimum required monthly payment is. So when we're talking about your debt to income ratio, we're not looking at how much you owe on a liability, we're looking at how much you have to pay on a liability. Now, if you have student loans, a common question I get is, well, my student loans are deferred, so can we just not count those? Well, that's not true. We normally have to count something towards the student loan payment. Now, if your payment is deferred, we either have to count 0.5% or 1% of the total balance due as a monthly payment, depending on what loan program you're going for. Or we can get a letter from the provider that usually helps us determine what the minimum monthly payment is. Or sometimes the actual payment does report on the credit report, so we would just use that in the debt to income calculation. Now, collections are another big deal that we look for on your credit report. We can do loans with collections. Now, if you have any student loans or federal debt that's in default, unfortunately, we cannot do an FHA loan, but we could potentially look at doing a conventional loan. Now, if you have collections that total more than $2,000, typically what we have to do is count 5% of the total balance due towards your debt to income ratio. Now, this is not a payment that you have to make, but it would be in place of if you had any settlements or anything on those collections. That's essentially what the lenders are doing with this 5% rule. And there are sometimes reoccurring payments that we see in bank statements that aren't necessarily reported on a credit report. For example, I had a borrower who did a debt consolidation program. The debt consolidation company did not report what their minimum debt consolidation payment was, but we did see it on their bank statements. So we had to count that towards their monthly liabilities. Moving on to income, there are 2 different types of income we can look at. There is stable and variable income. Now, stable income is going to be your full-time W-2 position, whether it's an hourly rate or salary. And then your variable income is literally everything else. That's your 1099 income, self-employment income, commission, bonus, overtime, those things. So stable income can be counted after 30 days. But if we have a gap in the 2-year employment history, we have to wait 6 months to be able to use that stable income. Now, variable income is a little different. Sometimes we can count it after 12 months if there's positive reporting factors, but most of the time we're going to have 2 years of proof of receipt, 2 years of documentation to show what the average income would be for that source of income. Now, we cannot use any past income towards qualifying. I have had borrowers in the past say, well, my last job paid me X amount. Can't we just use that towards qualifying? Unfortunately, no. We cannot use that towards qualifying, but we can use future income towards qualifying with proper documentation. Now, once we have all of these factors, we can calculate your debt to income ratio. So far, we've looked at your credit report. We've figured out where your credit score's at. We've determined if there's any negatives on the credit report that would potentially prevent us from doing the loan. And then now we've calculated your debt to income ratio. So the last thing we need to figure out is, what are you going to do with the down payment? So this is where we talk about our assets. Now, we can count any seasoned funds right away. So seasoned funds are any cash or any funds available in checking and banking accounts that have been in the accounts for more than 60 days. So we have 2 statements that have no large deposits in the accounts. We can count all of that cash towards the assets, towards the transaction. Now, if we do have large deposits, we will have to source where those deposits came from. So guys, remember, cash is a no-no in the mortgage industry. So if you have 10 grand in cash in a safe and you're looking to buy a house, you're going to want to put that cash into a bank ASAP so those funds can season. Because if a lender sees a large cash deposit and we don't have any documentation on where it came from, unfortunately, we cannot count it towards the purchase. Now, large deposits are going to be, depending on what loan program you're going for, could be 50% of the qualifying income, of the monthly qualifying income, or 1% of the sales price. Now, we can count retirement accounts, gift funds, and equity from a pending sale towards assets. Of course, we just have to have the proper documentation to count those towards the transaction. Now, this is going to tell us what our cash to close is. So when I'm doing a consultation with a borrower, we talk about down payment, and then we also talk about closing costs. Closing costs are any of the costs associated with closing a loan, which includes setting up your escrow account, paying for title fees, doing anything along those lines that have to do with the transaction. So we estimate where your closing costs are at and add that to the down payment, which gets us your cash to close. Now, sometimes depending on the loan scenario, we have this thing called reserves. So reserves are any funds left over after the transaction is complete. Reserves equal 1 monthly mortgage payment. So if you need 2 months of reserves, you need 2 months mortgage payments in reserves ready to go. Now, reserves, again, can be counted through retirement accounts. Typically, we can count them from gift funds, or we can count them from any of the cash that's in your accounts at the moment. Now, once we have all of this information, we can typically tell if we're going to be able to do a loan or not. Of course, we still need to do the loan application. We need to pull the credit report. We need to get some documentation to make sure that we're going through all of the checks and balances to make sure the loan is doable. And then once we do that, we can write you a pre-qual letter, get you under contract, and then submit your file to underwriting. If you guys have any questions about how to mortgage, or if you're looking to buy or refinance in Florida, give me a call. My name is Josh, Florida Mortgage Dude, powered by American Home Mortgage, and I hope you have a fantastic day.